National Property Data Tour. What has happened around Australia in the different states in terms of property for the last quarter versus last 12 months. And if you are buying a property in the different states, what are some of the costs involved and how do they differ for entering the market, exiting the market, and holding on to property? We have with us, joining us today for our Paris and Bazcast, Arjun Paliwal, a well-seasoned buyer's agent that has been on our podcast for quite some time and always a wealth of knowledge. So welcome again, Arjun.
Hey, good to be on, guys. It's always fun catching up with you two.
Absolutely.
Definitely, always a wealth of knowledge. So looking forward to this one.
Yeah. So I'm looking forward to your the presentation. So let's get right into it. You've got us a presentation about what has happened around Australia for the last quarter versus last 12 months.
Yeah.
Let's dig in.
I mean, I'll start off with grabbing screen share off you guys, if you can give me that.
Yeah.
Take that off you.
Yeah.
A lot of activity happening all around Australia at the moment.
Yeah.
There you go. Now, look, I definitely got a little bit to share here. So let me know when I'm on the screen share. I think I should be on now.
Yeah, I can see you. Yep, we can see that.
Cool. So yeah, just thought I'd start off with, I guess, CoreLogic's recent share, which was pretty exciting to just see what's happening there. And last 12 months have been huge in Australia. It has been led by the premium markets for sure in the grand scale of things. But then we've also got many markets following along. 20% capital growth is substantial.
Wow.
So,
That's crazy.
And it's still going.
And it's still going, yeah. So, typically we'd say 5 to 7% is your long-term averages per annum. So firstly, it's large, but then secondly, it's not sustainable for it to keep moving at those levels for too long, but it is a huge amount of movement, right? When it comes to what's been happening in the last quarter, and over the last year, it's the regionals for sure that have been outpacing the capital markets, but they've both been moving to some very strong amounts. Regional Tasmania, for many that remember sort of pre-COVID, never stopped moving. It's kind of been carrying on from 2017, its growth cycle. It's just been continuing its move. But the growth rates that are being seen across Australia are very widespread. To take a look at how common this is, the last time this widespread sort of growth occurred was sort of 2000 to 2004. So for many people thinking when growth happens, it happens everywhere. No, it's not the case. We are in a unique time where it is happening in so many locations, but don't expect this to be the norm. There are some locations over the years ahead that will continue on their level of growth and some that starts to fizzle off. Over the 12-month period, Tasmania has definitely been the biggest standout, and both from Hobart and the rest of Tasmania. So it's been quietly kind of ignored in many of the headlines, yet it is the best performer across Australia.
What's driving that?
So see, the thing of what's driving right now is definitely the most difficult question to answer. And the reason is not because of what it is, it's because there's never been a time where it's this many things driving it, right? From low levels of stock to increasing buyer demand to cost of money, availability of money, infrastructure, lifestyle preferences. So it's almost like the what is everything. It's almost everything coming together in this one time, driving it up. It's not just one thing, because I always think of, cheap interest rates, right? When money is cheap, you look back to when it was in its downwards trend, and Perth and Darwin were still not improving, even as money got cheaper every year.
Yeah.
So it's never really that one thing in property markets of late. I've been really seeing that it's a mixture of so many things coming together.
And I think it's overall confidence in the market as well at the moment.
I mean, it's huge confidence, right, in terms of what's happening. So when we're looking at our rolling values on a quarterly level, CoreLogic data is definitely saying that we have passed a peak rate of growth. Going to the quarter prior was when we really saw some of our biggest month-on-month or quarterly growth rates. You can see a little bit of a shift in the curve. However, it's important to not fall to the trap in terms of thinking that just because growth is slowing means growth is not happening. Remember, growth should not be at this level all the time, and it never has been at this level all the time. It's usually condensed periods of high growth, right? So it falling down from a 6% in a quarter to a 3 or 4 is definitely no slow journey when you annualize it. but the rate of growth is likely to continue at slower pace as things increase mobility.
Yeah.
Looking at the sales market, one thing we love to track as well is checking out sales volume averages versus their 5-year averages. And you can definitely see how big that's rising in terms of the national movements. Sales volumes in isolation is not a huge sign of growth, but it is a sign of confidence. The only reason why I say it's not a huge sign of growth is some newer communities can have large sales volumes, larger than the history. And then what happens is many people can think it's growing, but really it's just high transactions. But then there can be some, areas where sales volume definitely does mean more people are buying. And as a result, there is greater growth that's likely to happen. So a lot of change in sales volume across the country. I definitely feel when it comes to the Darwin and Perth, because they've had it rough for so long, to see these great conditions, a lot more people have come to market to start to capitalize of these greater times. Whereas other areas, even amongst lower listings, volumes are rising. So what I tend to see when sales volumes rise, especially as listings have fallen, it's now converting from a supply being low boom to a demand driven boom. So the first quarters was definitely a listing fall off the cliff. Now it's the buying data is outpacing the listing in many cases.
Right.
Speed to sell, another great indicator. Things are definitely faster from many markets from last year till now. Over the recent quarter, we've seen some areas slow down a little bit, but that's still at very fast levels. And this slowdown is likely just that vendor kind of expectation that's changing as markets boom versus what the buyers are willing to pay. Doesn't mean all of a sudden that places aren't moving or anything. They're still moving rapidly, moving much faster than last year, but we are seeing some locations with it easing off in terms of the days on market reduction. You can see it's quite widespread when it comes to the decline, looking at last year till now. The same can be said with vendor discounting. Vendor discounting rates are getting smaller. So when we see that line trending up, it's a good thing. Less discounts happening across the country is definitely a sign of what's happening in the current market conditions.
Yeah.
This was the big story of what really started this all, right? Looking back at the listing decline and what's happened in terms of the listings. These are some of the years prior, and credit to CoreLogic for this data here. So these are some of the years prior, but listing is definitely trending a little bit up, which is why I say that huge reduction in listings was a big part of it to begin with. But now many markets are going to be tested, right? Those markets where their demand levels are remaining quite high on the sales volumes may continue to soak up the listings, but there are areas where the listings starting to pick up will mean a slow in the rate of growth.
Yeah.
This is the same thing, just kind of over the long-term 5-year averages. When it comes to listings, we've got a bit of a mixed picture. Obviously, Australia total listings from the same time last year is lower, but you can see the regionals versus the capitals is a huge change. The combined regionals have reduced a massive 35%, where the capitals have reduced 12%. Melbourne has picked up in its listings in comparison from the other markets, but lockdown has a big piece to do with the change in timings and so forth. So the key here as well is that new listings change in Darwin. You can see what I meant by, because they had so many years of decline, people are finally seeing an opportunity to sell off and get certain assets out of it. They're coming to the market and bringing those properties through.
Yeah, we're definitely seeing that in the market. A lot of the vendors are cashing in now that have held for a long time, waiting for this growth.
Exactly. And so from a listings change, there are still some markets that are definitely different. So Brisbane's new listings change has not been huge, so pressure is still quite high, and Sydney still quite high pressure as well. As we know, weekly clearance rates have definitely been on the high. They had this big dip when it came to the lockdowns that happened across our two most popular auction cities, being Sydney and Melbourne. But some things that are interesting as well is the rate of auctions that are happening in your Brisbanes and Adelaides. They typically weren't known as those auction cities, but not only are they having some great volumes, but they're also having great clearance rates. So I can see vendors definitely embracing a new way of selling in these cities, where it might be the norm in Sydney and Melbourne. Many vendors are now starting to appreciate the benefits of auctions when you do get the campaigns right. The recent announcement by CoreLogic was around their rental changes. They were huge. Some of the biggest changes that have happened with 8.9% movements in rental changes. Both capitals and regionals really playing a big part here. Our two biggest cities, Sydney and Melbourne, not as much. But from Adelaide, Brisbane, Perth, Hobart, and Darwin, we're seeing some huge movements in rents. Regional Queensland as well has been very, very popular. The vacancy rates for most regional locations sit well below 1%, which is both healthy and unhealthy. Healthy from investors seeing some great returns and increasing rents. They can test certain markets, but unhealthy due to the number of people that are missing out, are seeing rents rise within, right in front of them within the last few quarters. So
we're seeing that on the
Massive,
ground. We're seeing, like, what we are seeing is that a lot of people that have sold their property are unable to buy again because there's not enough stock. They also wanting to rent, which is artificially inflating that demand for rentals. And then there's those that have been given notice by their landlords saying that the landlord wants to sell. They're also out there looking. So there's just a culmination of all these factors that's really driving that local market here as well.
Yeah, what you're touching on is actually one of the biggest pain points in Australia, and I call it stock mobility. And the issues that we have for housing affordability, firstly, I think housing affordability is probably the wrong word to use because it's still very affordable in many areas. But I would say the issue that we have with this tight stock levels is definitely to do around things for mobility, right? When I say that, the lack of incentives that people see when they have to buy and sell in these type of conditions, especially with all the government costs tied around it. I contributed a piece of information to a few mainstream media areas on capital gains tax, and recently on savings.com share my opinion. And what I found was that this belief that people feel capital gains tax the discounts should be reduced for investors because it's causing speculation. Absolute rubbish. It has not been, to be honest. They should probably increase the discounts for capital gains tax because that alone is causing restrictions. If people have to think about a longer period of time to make profit before they consider selling, more stock levels are held tight. So I think right now the key is how can we solve stock levels that are existing, not necessarily building our way out of it. It just can't happen. You have to figure out the pressures of existing stock and moving those a little bit more to create some ease in pressure. We can talk about dwelling approvals now. So they had the big change in dwelling approvals for detached dwellings. You can see a big spike in home builder around this time that created that. Yes, the detached dwellings are well beyond our sort of previous highs of detached dwellings driven by stimulus, but overall units have been trending down and are quite flat, well below long-term averages. And even with houses going up, they can't sustainably achieve that rate without all that pumped stimulus. So they're going to see themselves go down. I do feel that this rate of building will come to fruition over the next year or two and start to release some pressure in vacancy rates. But it's, again, not enough based on the number of dwellings to create a huge dent in terms of the supply issues being seen. Same thing when it comes to credit. We can see owner-occupier finance has taken a huge jump. It has fallen off, but it's still at substantial highs in comparison to previous years. Same with investor lending. Investors are definitely on their way back. It's definitely back to your peaks of 2015, 16. But to say that this has been investor driven would be incorrect because the owner-occupier finance growth from 2004 going beyond these trends is actually triple versus the investor growth of just over double or just under double. So owner occupiers have been leading the charge over the last 15 years for sure. This was kind of the joint picture of both the dwelling approvals and housing credit. What I might do is I might skip through to an interesting chart that we've been working on using some of our data here that we've been going into. And what I thought I'd showcase to everyone is what we call statistical area level 3s. And they're kind of just, the best way to say it is cluster of suburbs. Now, what we're looking at is which cluster of suburbs or, macro areas, SA3s, have actually not had a lot of growth over the last 10 years. But we've actually just found 77 out of 330 SA3s where they've not had at least 50% movement in the last 10 years.
Mhm.
Now, why that's important is that as investors, we can start to look at 1 year versus 5 year trends for price movements,
Mm.
1 year versus 5 year trends for days on market movements,
Mm.
1 year in vendor discounting, vacancy rates. And then we can also start to move 1 year versus 5 year rentals.
Mm.
So to give you an example of what I mean by this data, let's just say I take into account Bundaberg, right?
Mm.
Bundaberg has seen 12.63% growth over the last 10 years. We can all say that's very sluggish, very weak, not a lot of it.
Yeah.
Right?
Mm.
However, its 1 year movement far outpaces its 5 year movement for prices,
Mhm.
meaning that if you averaged out the 1 year movement of 9% over the next 3-5 years, it would substantially outperform the 5% of movements that it's had.
Mm.
Meaning that what's happening in its recent 1 year of Bundaberg is likely the start of a new cycle, considering it's so far ahead of its last 5 years.
Yeah.
Yeah.
The same thing here with if we look at Bundaberg's inventory levels are down 36% over the last year.
Mm.
Bundaberg's rent over 5 years moved up 19%, so an average of call it 4% per annum.
Mm.
Whereas over the last 1 year, Bundaberg's rent has moved up 9.3%.
Mhm.
So it's a clear sign that something is happening in these areas. So right now, I think with so much heat happening in the market across the country, we're trying to keep an eye out on what's happening where there have been areas over the last 10 years that have not quite hit the 50%,
Mhm.
but showcase phenomenal 1 year trends in comparison to the 3, 5, 10 to sort of highlight that something new is happening. So
Future. Yeah.
Yeah.
Future. With better.
Barossa Valley is another great example. It's only moved 19% over the last 10 years,
Mm.
but 9% of that 19% was in the last 1 year. So clearly something's happening that's outweighing that
Yeah.
average over this way.
Mm.
Same with a few other areas. When we start moving down the list, we can see Toowoomba has moved 34% over the last 10 years, but
Mm.
over the last 1 year, it's done 8%. So it's clear that something new is happening in these areas.
Yeah.
So I think when investors are looking at value across the country right now, where can they see markets where they haven't had a huge amount? This could be one way to then look at it to see, are there 1 year trends starting to outpace what's happening?
Mm.
And this could be a way to kind of just find some gems where, you're not hoping for a location that's done 100% to do another 50%,
Yeah.
because that's a lot harder for it to climb that curve.
Mm.
100%. Yeah.
In the last year, I mentioned a few regions that have been standing out in terms of their 1 year trends. Going across, I've got a few picks. So we can see what I mentioned before. Bundaberg, we have only seen that such small 10-year movements, but in the last 1 year, we've seen the curve here, the black line, days on market, fall off an absolute cliff.
Mm.
We've seen sales volumes rocket up in Bundaberg with more deals happening. We've seen stock levels drop by 36% over the last year. We've relevant to sales. We've seen vendor discounting drop 21%, and we've seen prices rise 10%. So it's clear that something that's done the complete opposite over the last 10 years, but people are selling faster, buying more, discounting less,
Mm.
and have less stock available. Something clearly is worth investigating in Bundaberg for those who are looking across the country.
Mm.
Looking at the rental markets of Bundaberg, we're seeing rents really start to increase here as vacancy rates are at 0.2% or 0.3% for the city.
Mm.
And that too, off the back of a 10-year rents that have not driven much. They've only moved 25% over the 10 years, which means these rental conditions could spark a rental boom as well, which is already happening based on what we're seeing.
Mm.
We can see rental listings like you're talking about just fall off the cliff. There's so few of them. And we can see yields remain pretty healthy at over 5%. So when time where money's been that cheap and growth is starting to happen and rents are moving, little markets and nuggets like that can be quite strong for a portfolio.
Mm.
If I'm doing another round of the country, going over to Victoria now, looking for little areas that might offer some hope for potential amongst such widespread boom. Shepparton's another one where, again, 10 years wise, it's been quite consistent. So this is one thing that may surprise many people. People led to believe that our big cities are the ones that hold consistency. Shepparton's a great example of a 10-year movement of close to 50%, so 5% per annum, very consistent. Prices, though, are rising strongly, 14.1% over the last 12 months. Stock levels are falling, discounting falling, and days on market is falling since September 20th, very strongly. From a rental market, Shepparton, the same thing here. Rents are rising consistently over the last 10 years. Vacancy rates sit at 0.55, and rents are rising in response to that vacancy rate. Thought I'd do a little bit of a field trip down over to New South Wales now, and we're here in Central Coast. And this is a market just to showcase that, okay, we had somewhere first Bundaberg that was not rising so much over 10 years. Look at what's happening there now. The second one we had was Shepparton, a consistent market over the last 10 years, and now it's still buzzing along. This last one is Central Coast, where it's had a huge last 10 years, and yet it's found another leg in it to keep going for that little bit more. So you can see the last 10 years have been phenomenal at 104% capital growth for this region, almost 10% per annum, or more than 10%. Vendor discounting continues to fall, and there is no slowdown in the speed of sale. It continues to fall, and so does the buying rates. They continue to grow. Inventory falling, prices rising by a huge 19%. Now, when I say Wyong's rising as 19%, that's an SA3 region, which means so many suburbs must be rising for that whole region to rise by 19%, which is huge news for the Central Coast.
Yeah.
And the same thing, the last slide here is the vacancy rates. The rental trends, I think rents still have some room to grow in Central Coast, having risen only 32% over the last 10 years. Vacancy remains at 0.5% for the whole region, which is very, very low, and rental listings falling and yields falling. Now, the key thing to be mindful of is that your yields in Central Coast are not going to be the same as your Brisbane or Adelaide's or a few other areas. It is a little bit lower.
Yeah.
But when you compare those yields to some parts of Sydney near coastal markets, this is actually quite healthy in the high threes, right? Because someone telling a Sydney side a high 3 yields, they'll be like, that's great cash flow. You know what I mean?
Yeah, exactly.
But that's pretty much it for me on a high level when it comes to a bit of a data tour. It's clear that a few things are happening. The supply is not quite keeping up with the level of demand that's around Australia. The regionals are outperforming our capitals, but still our capitals are huge in terms of their performance. 20% has been what the norm has been over the last 12 months. And rates of price growth are slowing, which is okay, but they're slowing to still some high levels. Our expectation going into 2022 is that we still see close to double-digit, or if not more than double-digit growth over the next 12 months before we start to see it taper down. I don't think it'll be another 20%, but you will see double-digit growth across the national markets, in our opinion.
Which is quite strong.
Which is, because there was an article more recently, and look, obviously everyone's got their own take, but they're anticipating a reduction of 20% and for all of their reasons. So there's all, and every market there's the doom and gloom, and then there's the optimism, which is actually backed by valid research and data. And I think that's what's key takeout out of this, is that when you do have friends that say, oh, look, don't buy now, it's going to drop. You don't want to be making those decisions on what they are saying. Have a qualified resource, educated opinion, and someone, and when you're buying for your family, that's always a different thing when you're buying an investment. So if it's the right thing for you, for your family, don't let the market stop you. I think that's the bottom line out of this, isn't it?
Exactly right. And I also think that, going into 2022, yes, we're going to see many areas where the listings coming up are going to test certain markets. But our thoughts here are that at least 2/3 of those markets being tested will pass the test. And we will see some that kind of do slow down and flatten. But I do think that we're looking into a pretty strong 2022, the way things are going.
Absolutely.
100%.
And in terms of a case study, as we were talking about, so in the entry cost and exit cost and holding cost. So just a grand scale. For those that would be wondering what that is. So to sum it up, entry costs are your stamp duty in a nutshell. Then you've got your exit cost is your CGT, and then your holding costs are like your land tax and all of the other costs in between. What is some of the sort of high level comparison of the different states, when you're purchasing a property of a certain amount?
Yeah, it's a really good question, because as investors or anyone just purchasing in respective states, the main thing you've got to be aware of is those costs going into it, right? And so by that, one should consider the entry, and stamp duty seems to be the biggest one. Now, when we're looking at things like stamp duty, what I've come to find, if we take a 750K example, and if you put together, say, stamp duty, lawyers, pest and building inspections, and some bank fees, for a 750K investment property, that could be up to $45,000 in the most expensive state. Right now, that being Victoria, and closely behind it by 1K less is South Australia. If we're looking at the opposite spectrum, if we're going to Queensland now and ACT, this number drops to 25 to 32,000. So 25,000 in ACT and 32,000 for Queensland. Now, Queensland, New South Wales, and Tasmania and WA all sit in the 30 to 32. Whereas NT, SA, Victoria sit in that 40 to 45. So from the low point to the high end, excluding ACT, we're looking at a $13,000 difference, including ACT at $20,000 difference. So it's pretty amazing, like how wide those differences are. I mean, if you think about an investor and you're making a decision, I've seen many now rule out certain states because it doesn't give them enough money to operate in. It'd be so much cleaner if we had a similar stamp duty across the whole country that was the same. Just because, you know, you can see now that for me to buy the same 750K property, I might now have to reduce that to the 600 to 650 in Victoria if I only had X amount of cash. So it does mean that less dollars can flow through when you start to think of those upfront costs. Now, when it comes to holding costs, you know, what we found was pretty interesting. You know, if we looked at, say, certain markets of Queensland, Bundaberg, Toowoomba, Hervey Bay, Cairns, Townsville, they had elevated insurance levels, and insurance premiums for some of these markets could be a couple hundred more. But to some markets, they could be double the price.
And is that weather driven?
Weather driven largely. And so that can be a key thing. But one thing I've learned in this analysis is that even when things are higher, it doesn't mean that they're higher just on the expense side. One thing that governments need to learn when tinkering with anything to do with investments is that investors will respond by increasing rents.
It's a
And
flow-on
so,
effect.
you know, whereas in Queensland, you have the highest outgoings for holding the asset across many parts of the country, you actually also have the highest yield distribution of markets where 4% plus yields exist, 5% plus yields, and even 6%. They're the highest in Queensland, driven by those areas that have high costs, as well as those areas that might be like mining economies or things like that. So in terms of the holding costs as well, one thing that many people need to consider is the differentiation between land taxes and land tax values. And this is where it becomes a whole new world. You know, you've got now discretionary trust versus unit trust versus personal ownership. And then you've got certain land tax holdings within them. And then you've also got land tax thresholds that differ from state to state. For example, in Tasmania, you might step in as soon as you buy a property, you're paying land tax, right? Because the threshold's at 50K or 60K, so quite small. You start going to New South Wales, the thresholds are much larger, and you're able to have a property or multiple properties depending on where in New South Wales you buy. So I've often found that, you know, when investing, the whole starting cost of stamp duty could sway your decision of where you go. The holding costs of land tax should make a difference of how much you buy in one state, and you should start to consider multiple states. Then when it comes to the exit costs, what people will find is that, you know, CGT is a little bit more national than it is kind of, you know, state driven, but sales agent fees can differ between various locations. Property management fees can vary. Like many Sydney-siders and Melbourners get shocked when they have to pay close to 10% in Perth, or close to 10% in regional markets, or 8%. And you go, why is this so expensive? But on the other side of things, they are cheaper properties. So the manager, to make the same relative income, needs to manage maybe 1.5 times the properties someone in Sydney might have to manage to get the same income, right? So it's an interesting world when it comes to how divided entry holding costs are. On the exit cost, things are fairly similar, but the entry and holding are really what change from city to city.
Well, there you go. It's very, very interesting. And it's one of the most often asked questions by our clients. is that what is involved and what are the different costs and how do they vary. So all those clients are coming to you. So we referred a lot of those questions to you. So thank you very much for sharing your insights. Any final words before we wrap up?
Yeah, so I think if you're a property investor looking around Australia right now, the main thing that you could probably consider is to be as widespread as possible, because there are so many locations that have much to offer. Secondly, if you're considering, selling, I think right now, like the environment's a great environment to sell in based on how low the listing levels are. When I think of, what's happening and how much stock is deprived in the market, I feel that any person who's deciding to sell right now is going to get some pretty amazing prices.
Absolutely.
100%.
To sell. And you know how to come to if you're in the Sydney area. Perfect. Thank you very much for your time once again. And we will see you guys next time. Have a good one.